If you watched episode 17, you know how trade credit insurance is actually bought, the 5-stage placement process, what a submission looks like, how underwriters evaluate it, what a quote means, and how to get a policy live. That episode answered the how do I get it question. This episode answers the one that follows. What does it actually do? Here's a scenario that plays out more often than anyone in the industry wants to admit. One of your top 5 buyers goes quiet, 90 days past due. Your AR team has been chasing. You're not panicking because you have trade credit insurance. You paid the premium, you have the policy in the drawer, you're covered. Then your broker walks you through what the policy actually says, and the conversation starts to get complicated. Maybe the buyer is disputing the invoice. Maybe your exposure crept above the per buyer credit limit 3 months ago and you didn't adjust it. Maybe your shipping terms mean the clock hasn't actually started yet under the policy's waiting period definition. Maybe you're in a country where the insurer covers commercial risk but not government-ordered payment restrictions. And that's exactly what happened. The lesson isn't that trade credit insurance failed. In most of these cases, the policy is doing exactly what it was designed to do. The lesson is that the exporter assumed coverage they didn't precisely have. This episode is designed to close that gap. We're going to map exactly what TCI covers, exactly where it draws lines, and exactly what the math looks like when a claim actually runs. By the end of this, you'll know the 3 questions every policyholder should be able to answer, and what it means if you can't. Quick orientation on where we are in the series. Episode 16 made the case for TCI as a portfolio management tool, why it works structurally for exporters who are managing receivables concentration risk. Episode 17 walked through the placement process and how you actually get a policy in force. This episode is the natural 3rd chapter. You bought it. Now, what does it actually protect you from? And where does that protection end? This is the episode most people wish they'd watched before they needed to file a claim. Let's start with what trade credit insurance is actually built to do, because the structure matters. Most TCI policies are designed to cover 2 broad categories of loss. The first is commercial credit risk. This is the core of what most policies address. Commercial credit risk has 2 forms: buyer insolvency, meaning the buyer has entered formal bankruptcy, administration, receivership, or another recognized insolvency proceeding, and protracted default, meaning the buyer simply hasn't paid past the policy's defined waiting period without any formal insolvency proceedings. Insolvency is typically straightforward to document and relatively fast to claim. The event is objectively verifiable. Protracted default is the more common situation, and it requires patience. You have to let the clock run on the waiting period before the claim becomes eligible. The second category is political risk, and this is where a lot of exporters carry a false assumption. Political risk coverage, where it exists in a policy, typically addresses things like transfer and convertibility restrictions, a foreign government limiting or blocking currency conversion or cross-border payment, political violence that directly interferes with the buyer's ability to pay, or government-ordered cancellation of import licenses. Here's the critical point. Standard commercial TCI policies often do not include political risk by default. Political risk coverage is frequently a rider, a separately negotiated extension, or a standalone policy. If you're shipping into markets with meaningful sovereign risk and you haven't specifically confirmed that political risk is included in your coverage, you may be carrying that risk uninsured. The definition of a covered loss in your policy is precisely defined. It is not all non-payment. It is a specific category of loss, documented in a specific way, occurring under specific conditions, reduced by your deductible and co-insurance percentage. The delta between what you think you have and what the contract actually says, that's where the exposure lives. Now let's go into the exclusions. This is the heart of this episode. Most exporters who've read their policy know there are exclusions. Fewer have genuinely mapped how those exclusions interact with their actual book of business. I want to walk through 7 of the most commercially significant ones, not as an exhaustive legal inventory, but as a practical risk map. Exclusion 1, buyer disputes. This is the most common source of coverage denial and the most frequently misunderstood. When a buyer refuses to pay or pays partially because they're claiming the goods were defective, non-conforming, not delivered as specified, or subject to some other commercial dispute, there is typically no admitted debt under the policy. The insurer's position is straightforward. If the buyer has a legitimate legal basis to contest the invoice, the debt hasn't been established. There's no loss to insure yet. The dispute has to be resolved first. This matters enormously in practice. A buyer who simply cannot pay will typically make no claims about the goods. They owe the money, and everyone knows it. A buyer who is in financial trouble and looking for leverage may suddenly find issues with the quality of the shipment. Whether that dispute is legitimate or tactical, the policy generally won't pay until the debt is legally established or the dispute is resolved in the exporter's favor. The practical implication: your invoicing, shipping documentation, and delivery confirmation procedures are not just operational details, they are your claim foundation. If you can't demonstrate clean delivery of conforming goods, a disputed invoice creates a coverage gap that has nothing to do with your premium payment. Exclusion 2, per buyer credit limits. Every TCI policy has a maximum coverage amount for each named buyer. Exposure above that limit is uninsured. This sounds obvious. It is, and it happens anyway. Here's how. Your policy is placed with a $2 million credit limit on buyer A. That reflects the exposure your broker submitted at placement. Over the following 6 months, buyer A expands their orders. Your AR team accommodates them. They're a good customer. Outstanding exposure quietly climbs to $2.8 million. Nobody adjusts the credit limit. Nobody checks. Buyer A defaults. The policy pays on $2 million. The $800,000 above the limit is an uninsured loss. The discipline required here is regular reconciliation of live exposures against approved credit limits. Many policies have mechanisms to request limit increases, but those requests have to be submitted and approved before the excess exposure is created. Retroactive limit increases don't exist. For exporters with a few very large buyers, this is frequently the most consequential mechanical feature of the policy to monitor. Exclusion 3, the waiting period. TCI is not designed to respond the moment a buyer misses a due date. Policies typically require that a buyer remain past due for a defined period, commonly 90 to 180 days beyond the maximum credit terms, before a protracted default claim can be filed. This is the waiting period. During the waiting period, the risk is yours. The policy is in force, the premium is being paid, and the coverage will apply. But not yet. The exporter is carrying the loss in their AR during that window. There are 2 things to understand about the waiting period. First, the clock typically starts from the maximum credit term date, not from when you first notice the buyer is slow. If your terms are net 60 and the buyer is consistently paying at day 70 but hasn't formally defaulted, the protracted default clock may not be running at all. The trigger is the contractual due date, not when your AR team starts following up. Second, the waiting period interacts with your notification obligations in a way that can void coverage if you miss it. More on that in a moment. Let's cover 4 more exclusions that are individually straightforward but worth having mapped clearly. Political risk without the rider. Standard commercial TCI covers buyer-level credit risk. The buyer can't or won't pay. It does not automatically cover scenarios where a government action blocks or prevents payment. A central bank restricts foreign currency transfers. An import license is revoked by government order. Sanctions create a legal barrier to payment. These are political risks. If your policy doesn't specifically include a political risk extension, these scenarios are excluded. Self-imposed extended terms. If your policy covers receivables up to net 90 days and you shipped a particular order on net 120, the portion of credit extended beyond the policy's maximum terms may be contested by the insurer at claim time. Pre-existing or foreseeable circumstances. A buyer who was visibly in financial distress before the policy incepted may be excluded from coverage if the insurer can demonstrate that the loss was foreseeable when the policy was written. Related party transactions, receivables from affiliated entities, subsidiaries, parent companies, commonly owned entities, are typically excluded. If a significant portion of your AR involves intra-group invoicing, that's worth clarifying at placement. Now the math, because this is where the I'm covered assumption often runs into arithmetic. TCI policies have 2 structural cost-sharing mechanisms that determine the net amount you actually collect when a valid claim is paid. The first is the annual aggregate deductible. This is a first loss threshold, the total of all covered losses in a policy year that you absorb before the policy pays anything. If your aggregate deductible is $100,000 and you have 3 claims totaling $250,000, the insurer pays on $150,000. You absorb the first $100,000. The second is coinsurance, sometimes called the co-payment percentage. Even after the deductible is satisfied, most TCI policies pay only 80 to 90% of the covered loss. You retain 10 to 20%. This is intentional. It aligns your incentives with the insurers. Let's run a concrete example. Suppose you have a $500,000 buyer default that is fully covered. Clean delivery, admitted debt, waiting period satisfied, exposure within the credit limit. Your policy has a $50,000 aggregate deductible, which you've already met through smaller earlier losses, and a 90% coinsurance rate. The math: 500,000 times 90% equals 450,000. That's your net indemnification. Now run it with the deductible not yet met. 500,000 minus 50,000 deductible still outstanding equals 450,000 times 90% equals 405,000 net. The point isn't that these are bad numbers. A 400,000 recovery on a 500,000 default is meaningful protection. The point is that the net indemnification is almost always lower than the headline loss. Exporters who are planning around TCI as a dollar for dollar backstop are planning with the wrong number. Policy mechanics matter as much as coverage scope. And of all the mechanical requirements in a TCI policy, notification deadlines are the ones most likely to kill a valid claim through process failure. Most policies require you to notify the insurer when a buyer becomes past due beyond a defined threshold, often 30 to 60 days past the maximum credit terms. That notification triggers the formal monitoring of the account. It's not a claim. It's an early alert, but it's a contractual obligation. During the waiting period, you're generally expected to document your collection efforts. Phone calls, written demands, communications from the buyer about why they haven't paid. This documentation is your claim record. After the waiting period runs, you have a defined window to file the formal claim. Miss that window and you may have forfeited an otherwise valid claim. Here's the failure mode. An exporter monitors a slow-paying buyer, waits to see if they'll come good, decides to give them more time, and during that extension misses the notification deadline. The buyer eventually defaults formally. The exporter files a claim. The insurer reviews the timeline and notes that notification was late. The claim is denied, not because the loss wasn't covered, but because the process obligation wasn't met. The discipline required: know your notification deadlines before a buyer goes past due, not after. Calendar them. Treat them as hard contractual dates, because they are. Everything in this episode comes down to 3 questions. If you have a TCI policy in force right now, these are the questions you should be able to answer off the top of your head. Question 1. What are my per buyer credit limits? And are any live exposures above them? Pull your approved credit limit schedule. Compare it to your current AR aging. If any buyer's outstanding balance exceeds the approved credit limit, you have uninsured exposure right now. Get a limit increase request in front of your insurer immediately before there's a problem. Question 2. What is my waiting period? And what are my notification obligations during it? Know the exact number of days. Know what triggers the clock. Know when you're required to notify the insurer and what that notification has to include. This is operational knowledge that needs to live in your AR process, not just in the policy document. Question 3. Does my policy cover political risk or only commercial default? If you're selling into markets with meaningful sovereign, regulatory, or currency risk, you need to know the answer. If you don't have political risk coverage and you need it, that's a gap that can be addressed through an endorsement or a separate facility. 3 questions. If you can answer all 3 with confidence and without pulling the policy out of the drawer, your TCI program is being actively managed. If you're not sure about any of them, the time to find out is now, before a buyer defaults, not after. Let me close with the framing I opened with. A buyer in your top 5 going 90 days past due is not a comfortable situation under any circumstances. But if your TCI policy is structured correctly and managed actively, you should walk into that conversation knowing exactly what you're covered for, exactly what your net recovery looks like, and exactly what process steps to take. That's what a well-managed TCI program is supposed to deliver. Not a vague sense that you're protected, but a precise understanding of the protection you actually have. If you're evaluating whether your current TCI structure covers what you think it covers, or whether you have the right program in place at all, the link to Impello Global is below. That's what we do. Help exporters understand their trade risk and structure the coverage that actually fits. Next episode, we'll be continuing the series. Subscribe so you don't miss it. Thanks for watching.